Hello there and welcome to the week ahead, the first week ahead of this year, given the break that we've had for the Christmas and New Year. So happy New Year to you. Hope 2026 has started off on the right foot. And we'll be looking ahead to the week starting January the 12th. That's with me, Fiona Cincotta, Senior Market Analyst at City Index. So as always, just before we start, I'm just going to ask you to read through the risk warning. I will pop myself on mute whilst you do this. Okay, so let's crack on. So we're just going to have a quick look at what's been going on this week, although it's worth noting that we still haven't had US unemployment, US non-farm payroll reports, and we still haven't had the, it's just coming now soon, in fact, the judgment from the Supreme Court in the US. So, but as we stand, US stocks are on track to gain just under 1% across the first full trading week of 2026. But as I said, things could potentially change ahead or after the US Supreme Court ruling and US non-farm payroll reports. Now, broadly speaking, I would say that the market has responded relatively well to the US intervention into Venezuela. So we did in fact see US stocks, particularly Dow Jones and S&P 500, reach record highs, and that's when they were boosted by the prospect of US oil companies being handed or being given the options to be able to go into Venezuela to help restore the oil production there, and obviously gain benefits of such a move. Oil prices have also, so this is just to let you know, this is the S&P 500 that we are looking at there. As we can see, it rose to that record high 69.65, just eased off very, very slightly, but I mean, we're still in that upward trend. Momentum slowed a little bit, but there's no reason to be thinking that this trend is doing anything but continuing that bullish move. 7,000, that is the next key level to be watching out for as far as the S&P 500 is concerned. The other one that I was going to say we've seen a lot of movement on is oil prices. Interestingly, they remain within this downward trending a channel, which they've been trading in since the beginning of July, but we have seen a little bit of volatility here. Obviously, there were some questions about what does this move by Trump mean for oil prices? What does it mean for oil production in Venezuela? And obviously then we also had the announcement from Trump about the 50 million barrels of oil, which was going to be a deal that was agreed between Washington and Caracas for $50 billion of oil. It's around $2 billion worth of oil. Now, the prospect, obviously, of increased supply to the market pulled oil prices sharply lower. That was this one here, where we got down to that low of around 55.76. So almost down at the 2025 lows of 55. But we have seen this jump higher, and that's to do with protests in Iran rather than anything particularly to do with Venezuela. Also to do with that slightly stronger than expected data that we've seen in the US as far as ISM services are concerned, and also the crude stockpile US data, which was also showed a larger draw than expected, which suggests that demand remains robust. But looking ahead to next week, as far as geopolitics are concerned, this is going to be very much going to remain in focus, with the markets really looking for any developments with regards to Venezuela, oil, Potentially Colombia, Mexico. I mean, we haven't heard anything more from Trump as far as there is concerned. But you know, he doesn't seem to be. Trump doesn't seem to be holding those off. We've also got Greenland. Now, Greenland is the big concern, I think, as far as the potential risks for the market is concerned. We've got Marco Rubio is due to meet Danish officials next week to discuss Greenland after refusing, basically, the US refused to rule out, or Trump, should I say, refused to rule out military action to seize the territory. Now, Trump has really doubled down on his threats to take over the strategic mineral-rich Arctic island, which is self-governing, but it's still territory of Denmark and also a NATO country. So I mean, there's a lot going on there. Is there any sense that the US could move ahead with military action to take Greenland? Or indeed, I mean, they've said they'd prefer the diplomatic solution, but I can't see, or there's been no sense that a diplomatic solution will be reached with giving Greenland to the US. So, I mean, this is something that's very much going to stay in focus, and it's something that potentially could, well, has been, I would say, weighing on the euro and also the Danish kroner. So this is an area that I would continue to monitor. It's very much on the radar and could potentially flare up next week, depending on that meeting with Marco Rubio. So as far as the euro US dollar is concerned, obviously the other thing, let me just show you, we'll come back to this chart in 2 seconds, but we're just going to go to the US dollar quickly. US dollar index has been pushing higher. So, I mean, if we just have a look, we've seen a fairly solid run in the US dollar since December 24th. It's recovered from the low that we saw December 24th of 97.75, risen above the 200 SMA. Now, we have seen a rise above the 200 SMA here, and that was not sustained. So we ran into resistance at the 100.35 level, which was also the November high. That is, I mean, we made it to that level, tested that level, and then rebounded lower. So we're just testing here the 50 SMA at 99. But we've seen a solid rally in that US dollar, which obviously is also what we're seeing weighing on that euro US dollar. So not only are we seeing that US dollar strength, but we're also seeing some of those concerns with regards to Greenland playing out there. So that's going to be one to be watching. And I think the other thing, let's just take a quick look at precious metals whilst we're talking about what's going on as far as geopolitical situations and safe haven trades. I mean, here we can see gold rose to that record high of 45.50. That was at the end of December. Fell sharply, really sharply, didn't it, just at the end of December. Now we fell to that low of 42.75, and the price has recovered on those safe haven flows. So we can see this is the Monday following the weekend where Trump, the US, intervened into Venezuela, and we can see that jump up in safe haven demand. And this uncertainty, the geopolitical uncertainty, is keeping the US dollar supported at these the US dollar gold supported at these levels, despite the fact that we're seeing US dollar strength. Usually when we see US dollar strength, we'd find that the gold comes under pressure, given that it's US dollar denominated, but that hasn't been the case because of the prospect of sort of ongoing geopolitical uncertainty. So moving on to that sort of themes that we'll be looking at, just going to have a look here. This is the economic calendar that we've got pulled up. Interestingly, obviously the Fed rate cuts was very much a driver, and Fed rate cut expectations very much a driver of the markets in 2025. We do have US inflation data being released on Tuesday. Now, this is going to be really closely watched, especially given that there were sort of those data collection issues for the November reading, following the longest government shutdown. Now, that actually led to a surprisingly cool November CPI report. But basically the reason for this is because the sampling for that report took part in the second half of November, which likely amplified the slowdown in price growth. So those distortions are expected to be unwound in the December report, which could actually result in December CPI ticking slightly higher relative to November's on the monthly reading. I think it's worth keeping in mind that whilst a rebound could be in store, the broad trend is expected to be lower compared to the sort of September reading. Recent PMIs have also been showing a tempering in prices paid and received since the middle of the year. So overall expectations are for the US CPI. Let's have a look at US dollar. Overall expectations are for US CPI to come in at 2.7% year on year, and core CPI to be at 2.8%. Now, the data comes as the Fed policymakers are I've shown that they're divided about the outlook for rates in 2026. So they still consider sort of weighing up whether the weakening jobs market or signs of sticky inflation is bringing the biggest risk to the US economy. So this is the US dollar Japanese yen. US dollar Japanese yen is particularly sensitive to rates expectations in both countries, in both the US and in Japan. So it does make it quite a good pair to trade when sort of weighing up Fed rate cut expectations. Currently, the market is only pricing in a 14% probability of a rate cut, of 25 basis point rate cut in the January meeting, and a 37% probability of a rate cut in the March meeting. So if we get stickier than expected inflation, then that obviously will see those rate cut expectations reined in further, could offer additional support to the US dollar Japanese yen. US dollar Japanese yen, what we're looking for here is this level up here, 157.80. It's a level that we saw tested on the 20th of November. It's a level we saw tested here on the 19th of December, and we are potentially going to be testing it again sometime soon. Now, if we get a break above that level, then that brings the 30-year high that we saw in 2025 of 158.90 coming back into play ahead of 160. However, as we get closer to those levels, and as we are around these levels, there are concerns and there's potential for Japanese authorities to threaten intervention. So it is worth being cautious as far as US dollar Japanese yen is concerned. Any sense of an intervention from the Bank of Japan could pull the pair lower, sharply lower. This may potentially only be temporary, because obviously intervention by the Japanese authorities, it's only temporary, it's only short-lived, but still those concerns of intervention may find that it does just keep some cap on US dollar Japanese yen gaze. Other one we're just going to look at here is NASDAQ. This is the NASDAQ attempting to break out in a triangle pattern at the moment. If we get weaker than expected CPI, that can obviously boost rate cut expectations and may help the NASDAQ breakout above the 25 26,800 level. If we get a break above there, that's going to bring 26,000 into play ahead of 26,230, which is the record high. So then that would bring fresh record highs into focus. And on the downside, I mean, you've got the 50 SMA there at 25,325, and also this level here, 25,200. That's the low that we saw. Sorry, 25,000. That's the low that we saw in January. So that would be a key level on the downside. Would also imply the breakout of this symmetrical candle to the downside, which would then bring the 24,700 mid-December and low into focus ahead of the 24,000 level that we saw tested twice in October and again in November. So that's we do have other US data as well to be watching, but I mean the thing is that US CPI is clearly the main focus. We've got retail sales and PPI, but you know, PPI, as we saw, it's still important. Obviously, producer prices are important because they are a lead indicator for CPI. But the fact we always seem to get them after the CPI, it's a bit like, you know, having the dessert before the main course, you know. It feels like it's the wrong order, and it does mean that PPI just generally gets less attention than potentially it would if it was released ahead of CPI. But retail sales, again, very much in focus because it will give clues over how the US consumer is holding up in light of sort of, you know, rising concerns over the health of the US jobs market and as inflation remains sticky. Now, talking about jobs market, the other jobs data that we'll be looking at next week is GBP USD, and this is because we'll be looking at UK jobs data. Expectations, I mean, well, if we just think back to what happened in the latest jobs report, that we saw unemployment tick higher to 5.1% year on year, and that marked the highest level since the pandemic. And the broader expectation is that UK unemployment will rise higher in 2026 as more companies come under sustained financial pressure, and that's due to, you know, high interest rates, rising energy costs, and increases in the minimum wage, as well as the increased tax burden from the budget, not the most recent budget, the previous budget that came into effect in 2025. Basically, unemployment is expected to potentially rise as high as 5.5% this year, according to the Bank of England. Now, in that latest Bank of England meeting, we did see that the BOE cut rates, and Andrew Bailey actually warned over a more cautious stance towards further rate cuts. But I mean, I think if we have a look at the fact that inflation has cooled more than expected, and the fact that the UK labour market is expected to weaken potentially considerably across this year, then there is a potential for further rate cuts from the Bank of England than initially expected. You know, if this data comes in weaker than expected, that could be bearish on GBP USD. If we just have a look at what's going on here, so I mean, this had been trading in an upward channel. We can see since this sort of like November low, we've seen that the market had been forming a series of higher highs and higher lows, running into resistance of that sort of 135.50 level, and hasn't eased lower, but it hasn't reversed completely the uptrend. So we're just going to be watching out for signs of that, really. We're seeing that momentum is fading. I mean, we've broken below, we've got the 100 SMA breaking below the 200 SMA. We've also see the price is sort of on track to, or should I say, testing this level here, which is the 134.20 level, which is a level which has been important. Let me just pull this one up here so we can see it. There we go. It's been, you know, a level that has been tested on numerous occasions across the past 6 months. If we get a break below there, because we get weak data or any USD strength, and we could see a test of the 200 SMA. And then below that, you've got this 133.50 level, and below that, an exposure of the 50 SMA there at 133. As far as on the upside, supposing we get stronger than expected jobs data or a weaker US dollar, on the upside, be looking at around the 134.80 level. That was the high that we saw in October. In order to rise above there to bring 135.50 back into focus. So yeah, so that's what we're watching as far as sterling US dollar is concerned. Other things to be talking about next week is there's quite a lot of Chinese data that is due to come out. So we've got the industrial production, retail sales, GDP, lots of data there to be watching, plenty to be focusing on. Obviously, there are a couple of markets you can be watching as far as that's concerned. Oil, for example, given that oil, China is the main importer of oil. However, given that there are so many other factors that are influencing oil right now, I'm not quite sure how clean that trade would actually be. But Aussie dollar, US dollar, that's the proxy for China, which is another one to be watching. Quite interesting because it's recovered from this low here in November of 0.6420. Forming a series of higher highs and higher lows up to 67.66 and has since eased lower. Now that's a really interesting candle. If we have a look at this one here, that's the shooting star candle, which does suggest the start of a reversal. So it's a bearish reversal signal, which we're seeing. Next test here will be on 66.65. That was the low that we saw in the start of January. Break below there then exposes the 50 SMA and the 0.6590 level, which was the low that we saw back in mid-December. On the upside, 67, round number, also the high that we saw back in September. And above there, that would bring the 67.70 level. That was the 2025 high into focus. So that is everything that we will talk about today. I do hope you've enjoyed it, and I look forward to seeing you again next week.